Okay, I hope we're live. I hope we're live. Okay. Okay, so we're gonna be doing the usual, just some tape reading. Okay, so let's get into a bit of the framework for today. One of the main things I have pointed out is this volume imbalance that we had created yesterday. And again, my weekly draw is this anchor high here. And if we go on the 4-hour, we can get some more insight of what happened yesterday during the PM. So we had swept these mitigation lows here, and then started trading higher. And if we go on 1 hour, within that big wick there, there was this inefficiency here that I was anticipating to get inversed, which I'm still looking forward to because we have been bouncing from this array to this array. And we go on the regular trading hours. Let me go up to the 15-minute. You can see we're currently filling this opening range gap with this respect of it being a higher draw. So whatever happens here, I'm not really concerned, but with whatever happens within this array, okay, so what I'm concerned with is I have two price conditions here. So whatever happens with this discounted array, and whatever happens with this premium array here. So what I can see here is that we took this high here, and then yeah, hello?
Hello. Hello.
Yeah.
Alright,
Yeah, I'm
what's
live,
up, man? Nice.
Okay. I was just going over the daily framework. For the hourly, it's really just in between two arrays. And hold on, let me share my screen. I'll go through it with you and we can critique it. Here. Okay, so do you see my screen?
Yeah, I see it.
Yeah, what I had my eyes on this morning was this bigger volume imbalance here. By the way, is this a new week opening gap from Friday to Monday? Some gap here?
Um, on your time frame, I think because you have it to set the bottom right.
What do you mean?
If you bottom right, the set button.
Yeah, this one?
Yeah.
Okay. Did I press it?
It. Yeah, where it closed, it's a volume imbalance. I wouldn't call it new week, but there is a new week opening gap. If you go down to the it's not that big though.
It's still here, right? It's like
Yeah.
this? Ah, okay, okay.
Yeah. I think that's more the one on if you put set on is a little bigger.
Yeah, okay, I see. Okay, yeah, I was meant about what you asked me for yesterday's PM session. Um, I looked into it and I noticed that we swept these mitigation lows, and then we've been trading higher since then. But if you go down to the hourly, right now we're in between two arrays between this hourly inefficiency and this hourly inefficiency. Um, Earlier this morning it was showing respect to it, but after we tapped into this hourly imbalance and then filled throughout the whole opening range gap, you can see we're displacing heavily through it, back into the new opening gap, and on the 15-minute, there is this mitigation block here, and if this mitigation block holds for the rest of the day, I mean not for the rest of the day, like until this run stops, then I'll probably see lower prices. But for now, I don't have a clear draw. Like this is just
Yeah,
setting
same.
price conditions.
Yeah, same. I don't really have a clear draw right now. Um, I wanted to see all I wanted to see this morning was 20,614 and a quarter on the 5 minute chart.
Say it again. Which number?
20,614 and a quarter.
14 and 42. Which level? Yeah, here. So was isn't this the inefficiency, the hourly inefficiency?
Yeah, yeah, you could say that. I was looking at the low at 658, but yeah, I suppose it's also the high of an inefficiency. Here, let me share my screen. You'll be able to see it actually.
Okay.
I don't know why I didn't do that. You see what I'm seeing?
Let me just full screen it. Yeah, okay.
The dotted line.
I see, I see.
Yeah, I just wanted to see price come and close beneath that. It was accumulation head of the 930 open.
That was the accumulation though.
If you take this part, the wick just quickly ran back down, and but if you look at the bodies on every time frame, even the 1 minute,
What does that tell you?
well, it accumulates stops lower and higher. Hold on, wait, I'm gonna close my Discord. It might disconnect me because it's frozen.
Okay.
You can still hear me?
I can hear you.
Okay, okay. What the heck? I have to completely shut down my Discord. I'll be right back.
Okay.
The fuck?
You're still in the call, by the way.
Really? What
Yeah.
the? I'm trying to close Discord. I don't know why it's not working. Okay,
Yeah.
I'm
Hello.
back.
Okay. Okay.
Hello?
Yeah, you're good. You're good.
Alright. Yeah, I want to see. I was mainly looking at this consolidation, and then I saw I had a 930 ran above it. I wanted to see if 930 would be willing to do a Judas swing. And when it went higher, I was only willing to have a higher bias today, not lower bias. So I would only look for longs. And when it went higher initially and left this liquidity down there, that's when I texted you around 940. I'm good to call because I knew I wouldn't have it. It didn't take out the liquidity it took first, and which just told me that we're not going to see that we're gonna have less liquidity up here at the high of the day, and we're gonna need to go a little deeper beneath that low and probably spend more time down here. But one thing though, you definitely want to look at, and this screams, don't trade today. Is the Dow. You see that?
Let me look it up for my chart. It's at all-time highs right now.
Yeah,
Yeah.
that it's not stopping.
What? Why is this
Even though
happening?
Nasdaq's going lower, it's just not stopping.
What?
There's I believe there's a lot of people are probably going into an industry. Remember like when I said that a lot of the industry was suffering because of higher prices.
I don't remember why, but I think I remember you saying that, but I don't remember the reason why.
Yeah, like the Dow was having a heart attack a couple months back. Now it's just catching up. And it's rallying because it was probably cheaper and it got bought up. I think if we have inflation, metals and or if we have like a recession, metals and goods are going to be more expensive, and so those companies will tend to have more profits. That could be why the Dow's going higher. But it could also be forming SMT, which is what's worrying me. Like if we have the Dow making that higher high above its all-time highs, and then Nasdaq on the daily chart is failing to do the same. It's showing you that the Nasdaq is the one that's leading to go lower, and since it's the bigger market, it could be seeing a high, but I don't try and pick the top. So I want to see. I'm giving this week to see what happens, but yeah, that's in a situation where you really don't want to trade if your daily bias is conflicted like that.
But my drawn liquidity for the Nasdaq anyway, it's this high here. So could it just be the
Yeah,
Nasdaq
me too.
lagging behind?
No, but that rarely happens. Um, the Nasdaq is a bigger market. Tech are more volatile. Like the last year, we were in a bear market, right? And tech was pulling everything higher because tech was the only thing going up. So now tech is lagging, but I do believe that all the other markets are in a bullish market. So I might be wrong about SMT, and it might be that now the Dow is catching up to the Nasdaq, and it's the one that's leading because the other industry, the stock market in the broader view is catching up to the tech stocks, and I think that the AI hype is sort of calming down, so there's not much money getting poured into tech stocks, and people are also scared of a bubble. That could be why the tech stocks are being a bit stagnant. Um, I just hope it's not SMT because I wouldn't line up with my analysis.
Yes, same with me. The exact same with me. Hopefully NQ will catch up with the high, the same as Dow. But I read something interesting last night. It was saying something about the S&P. Like if you remove the top five stocks from the S&P, I was 500 stocks. If you
Yeah,
remove the top five, like Amazon and Microsoft and I think Apple and those stuff,
top seven.
um, s- I, the S&P, the graph looked like this. I mean, the chart looked like this. It was just constantly making higher highs, and there was another index that did not include, I think, five of the top stocks on the S&P, and it was just it was making lower lows and kind of consolidating in a range. So what you said about the things with the top like tech companies and especially with the hype of AI dying down, it makes
Yeah,
sense. It makes sense with how YM is moving right now and how why it was so delayed for the past like a couple of months, and now it's catching like moves higher, momentum higher.
yeah. And I also pointed out the consolidation this morning, the consolidation, that kind of like sideways price action hourly chart
Yeah,
that we don't have on the other, um not really, like the S&P sort of, the Dow not really. but the Nasdaq's really moving sideways in a discount, so we could be seeing manipulation at these lows and a reversal here, which would be lagging behind the Dow. But it's weird because it's this transition, like the whole year, it's been a Nasdaq that leads, and now it's like, okay, well, it doesn't look like the Nasdaq is leading anymore. So it's like a weird transition, and I'm wondering if it'd be better to trade the S&P in these market conditions.
The S&P does not look clean at all, though. It just seems so choppy. And there's only like
Yeah, like
the S&P, what it does, I feel like it just accumulates and then expands, accumulates and expands, accumulates and expands. That's, from what I'm
yeah.
seeing, that's all it does. Accumulation, expansion,
Well,
accumulation, expansion, accumulate,
well,
expand.
right now certainly not because the Dow is absolutely horrendous. But if we didn't have a scenario where the Dow is going raging higher and the Nasdaq is raging lower, the S&P is always in between both of them, right? Because the S&P is the broad market, and the Nasdaq is more tech. The Dow is more industry. You have like manufacturers, a bit more financials, I believe, a bit more healthcare. So you have the very different sectors in the Dow and the Nasdaq, but the S both of them. It's the broad market of all the sectors, and so that's why like the S&P being bullish is really what's more important, and it's just showing that really it's the tech that is staggering a little bit because the you know what you said about those five stocks is that if you took those five, they it's true like they move the markets higher if you remove the market. So I think now that's not the case anymore, and so if they're relaxing a little bit, yeah, like it could just be creating this iffy condition.
You know what? I was lagging a bit for a second and I disconnected my Ethernet, so I didn't catch a lot of what you heard. Can you repeat that?
I was just summarizing the magnificent seven. No, you talked about the five. Yeah, the magnificent five stocks that are just pulling the Nasdaq higher
Yeah.
and the S&P higher.
Yeah, what about
No, I was just summarizing what you said.
oh,
But
okay, okay.
that if you had like removed them, you'd be in a bear market in the past couple years.
Exactly. Yeah.
But now I don't think that's the case anymore. I think we're in an actual bull market.
For the Nasdaq, and yes.
Yeah, but for the stocks in general, like the tech sector might just be lagging behind, but because the potential AI bubble and the AI hype is over. But I think if the broad market, despite the S&P and the Dow already having went higher, most stocks have not went higher and are now starting to see those gains. So I think that's all we're seeing.
Oh, and also, remember how earlier you were mentioning the 930 swing and how you wanted to see it move higher?
I want to see 930 juice swing go lower.
Oh, go lower. Do you want to
Yeah,
hear what I think about 930 swing and how it played out and the interest will move lower?
sure, sure.
Yes. So the first thing I noticed about 930 swing is that it moved it, and also if you factor in the opening range gap, which I'm starting to use a lot now, you can see that the 930 Judas swing drew just into the gap. So you can see 930 opened here, moved into the gap, and then started trading away. When I see this trading away and then it comes in contradiction with another 1 hour efficiency, I went on lower time frames and I started to see how we're going to react. So the first thing we have here is this mitigation being created, which is one of the first signs in shifting order flow, and then this inversion here, and then eventually when we close below this low, we change the delivery, and then we used this order block here. If I just draw it out, yeah, so you can see how we completely reject off of this price level here. And then when we started displacing through the discount of the premium, I anticipated the whole thing to be filled. And now, since we closed through the entire opening reach gap, and I'm thinking hopefully, like what you mentioned earlier, how ES is not taking all of these lows here. I'm hoping this is the S&T here, and then we can start seeing shifts in delivery, and we can start going higher, and then start using this as
Yeah.
I mean, start using the opening range gap to break through it, and then start using it as support to go higher, and then eventually meet the weekly draw, which is this high here.
Yeah, that's good. The only thing is that I don't like the Nasdaq going lower first, and if I'm trading the Nasdaq, I want it to lead, and so the longs will could be good on the Nasdaq, but it would be better on the S&P.
By the way,
Yeah,
is it true that the pair that makes the lower low, and if the other one doesn't make the lower low, the one that doesn't make the lower low is more likely to expand higher?
it is obviously more bullish.
Yeah, it's more bullish, but I heard someone speaking about like when, for example, right now when ES is not making these lower lows, um, it's gonna have
Mhm.
the more volume going higher. Is that true?
Yeah, yeah, it's gonna be way easier for it to go higher because the Nasdaq went lower, take out sell stops, but it went lower. The S&P might have sell stops at that same level, but if failed to go lower. It's showing you that the strength, the relative strength, it's a lot stronger in the S&P because it's failing to actually go lower. Even stronger in the Dow because it's failing to go lower.
How come stronger than Dow? Dow is just pushing higher and higher.
Oh, sorry, I meant the Dow is stronger.
Uh, but I think I'm gonna sit out until 10:30, and then um I'll see what happens then with the first hour range.
Yeah, I'm 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 I I'm very much considering sitting out the whole summer.
The whole summer?
Yeah.
Why the whole summer?
You know what the inversion curve is? The
The
yield
inversion
curve?
curve? No, I don't know.
Okay. Let me show you. If- this is no. Hold on, let me go on the monthly chart. Alright, this is the 0%. What this is two like how they work, the bonds. Hello?
But is it me lagging or is it you?
I don't know. Can you hear
Your voice
me
keeps
now?
cutting out. Hold on, listen. 1 second. Let me leave and rejoin, okay? Just give me a second.
Okay.
My Wi-Fi should be fine. I have no idea why it keeps cutting out. I have like 80 ms. I'm not sure why it keeps doing that.
Is
Okay.
there a sandstorm going on?
No. Okay.
Alright.
Go
Can
ahead.
you hear me?
Yeah, I can hear you.
Okay. So are you familiar with how bonds work? Like what is a bond?
No.
No?
No. You've explained it to me so many times, but I just can't grasp it.
Okay, okay. I thought when I'm explaining things, I always thought you knew what the bond was, but okay. A bond is very simple to understand. So when you have, let's say, a government that wants to have, gets into debt, like the United States, they have debt, right? A lot of that debt is in bonds. So this is the government. What the government does is they'll give investors or other countries or institutions some money, and then the company. So we're gonna call this the company or the investor or the country.
Okay.
is going to have a asset with the government, and the government will have a liability. So this is a balance sheet of the assets and the liabilities. Now the government has a liability, and the company will then have an asset.
Okay. And the liability is them loaning this asset to them, right?
This bond, it's a loan basically. The government is giving a loan, the company is giving a loan to the government, and the government is lending to the company
Okay.
or
Okay.
a country. Like Japan has 1.15 trillion dollars of U.S. Treasury bonds. That's because that's like the United States' debt. That's part of the debt in the United States. So you know how
Okay.
like the debt is like at 30 trillion something. A lot of that is because other countries are buying these bonds, and the government owes these other countries money. So this money here is the same thing as holding physical cash. It's just like if you're holding physical cash, like in your mattress. The difference is that it has an interest rate. So that bond will have, let's say the interest rates are at 5% right now. So a lot of the bonds are paying 4.5%. So the country is going to get 4.5% every year that they're holding that bond. And there's always an expiry date. So at the end of that expiry date, that's when that's when they get all the money they loan to the government back. So for an example, let's say they get a 10-year bond. The expiry date is 10 years. They give the government $10,000, or we'll use big numbers like 1 trillion. So 10-year bond for $1 trillion. Interest rate is 3%. Now, that interest rate stays static. The real rates though for the newer bonds which have higher interest rates, they're gonna be worth more. That 1 trillion they invested, they can go and sell it on the market and take a loss. But if they hold out all the 10 years, they'll get that 1 trillion back. Right? So it's kind of like it's considered very safe. The only way you lose money on this is if you sell it before the expiry date at a loss, or if the government can't pay you back. But it's the United States, right? It's not like a third world country. It's there's almost no risk. Many banks assume no risk. Some bonds though are like corporate bonds, they're company bonds, and they have more risk, but they also give more yield because the company would make more money. It's not necessarily tied to what the interest rates of the Federal Reserve, the Fed fund rates is. So everything revolves around these bonds because they're the most bought asset in the world. Trillions of dollars are poured into this every day, every year, right?
So
And
these are the
what?
bonds that go from the government to another country, and these bonds are in US
Oh, you're
dollars.
cutting
And
out.
then can you hear me?
Wait. Hold on. You're cutting out. You're cutting out. What's up?
Can you hear me now?
Yeah, I can hear you.
Okay, so I was saying, so this is the type of bonds that the government lends to countries, and for the government it becomes a liability, and for the country it becomes an asset. And these assets for the countries are almost 100% guaranteed to be safe investment because they can always pay it back if the interest rate drops.
Yeah,
That's basically what it is.
yeah. Because no, not if the interest rates drop. Because the U.S. government, they will be able to pay back as long as they don't default on their debt. I say if you have a corporation and you declare bankruptcy, your corporation's in trouble, not you. So the bank will seize all the assets of that corporation. If you yourself declare bankruptcy, the bank will seize all of your assets. So basically, if the United States declared bankruptcy, right, they would, well, it would be chaos. Just let's just say that everyone would lose homes. They wouldn't get any imports. People would start looting on the street. People would start to survive, have to grow their own food, and power would run out throughout the whole country for a while, probably. So, I mean, that such a big country like that, that would happen because there's just so much infrastructure and such a small trade deficit that it's not going to happen because everyone likes to use U.S. dollars. As long as everyone is using U.S. dollars, it's never going to happen. I mean, US dollars used to be worth gold, and they took it off the gold standard because it became the new gold. So US dollars think of it as gold. It's what everyone uses to trade. If you have US dollars, it's every country is gonna want it. You can use stuff to buy it in every single country. And if the US dollar goes up or down is the most important factor in what happens during market crashes, during well, in any market really. Like I always look at the dollar for anything I trade that's priced in US dollars because I know that automatically it's going to be affected. Like the dollar this morning, I had a draw that the dollar would go higher to buy side liquidity. I knew right away that if I'm trying to go long on the Nasdaq, it's not going to be very good because the dollars also want to go higher. So I was keeping that in mind, right? And that might just be lower your expectations. So do you understand that?
Yeah, okay, yeah. I think I have an idea about it, but I don't
Okay,
understand how things priced in US dollars are affected by the dollar going up and down. Can I not just price the Nasdaq, for example, in euros or in Canadian dollars? Why do I have to price it
yeah.
in US dollars?
Okay. Let's look at that. Let's look at the Nasdaq price in euros. It's gonna look different. All right. If you held the Nasdaq in euros, um, let me just type it in. The euro is pegged to the dollar, so it's gonna look the same. But I think if you priced it in maybe Australian dollars, no, this isn't actually representing it the way it should. Actually, I don't know why it's not. Okay. This is just doing the currency conversion from
Yeah,
US
yeah,
dollar to Canadian dollar.
exactly.
Yeah, but but if the dollar rises, like it's gonna make okay. So it's like supply and demand sort of. If you have more dollars in an economy, if the dollars are worth more, then you need less dollars to buy something. But if the dollars are worth less, then you need more of those dollars to buy
Okay,
something.
okay, that
So
makes sense.
as the supply of dollars increases, you have each dollar is worth less. Like $1 doesn't buy the same $1 bought 100 years ago, right? Because the more dollars came to the economy, and so everything is going to be more expensive since there's more dollars. But in reality, prices don't move. And if you want to know, this will shock you, but if you look at the Nasdaq, we'll look at and you divide it by gold. If you look at the Nasdaq against gold, it's went down since 2000.
Nasdaq against gold.
I think you cut out again.
I was saying, never mind.
So I'm you cut out. Did you ask any question?
No, no, never mind, never mind.
Okay. So the reason why I'm comparing it like this is because since the gold is also priced in dollars, it has real value, which is something that you can use to compare things too, because the gold will be worth different US dollars the same way the stock market will be, but the gold can really be used as money. So because it has that value, because it has a certain value behind it, it's able to be used as money, so you can use it to compare to other things. And if you use gold, you'll see that it moved sideways. I don't think it was maybe the Nasdaq was more of a bear market, but the Dow at least moved sideways. If you go all the way back to 1924, one stock of the Dow, whatever it was worth in 1924, I don't know, but if you held one stock, you could buy 19 ounces of gold. In February, March, you could only buy with one stock of the Dow, you can only buy 17 ounces of gold. That tells you that obviously this big difference. Well, between actual bullish markets and real time, compared to real wealth, it's not moving at all. Like it's moved sideways in 100 years. That's because the only thing that's going up is the supply of US dollars.
Okay, okay, that makes sense. That how it affects it with different pricing. Okay, okay.
Yeah, that's why the Nasdaq just goes up. The S&P just goes up in the past 30 years, in the past 50 years. The Dow just goes up because as long as the United States is still in power and everyone's using United States dollars, it's always going to go up. It might have
Okay, 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 okay. That makes so much sense. Okay.
small market crashes, but overall, it's always going to go up. Yeah. Now these bonds. One more thing is the 10-year. It might be a 5-year bond. The biggest one is a 30-year bond. I don't know if there's bigger than that, but then there's a 5-year. There's 3 months, 2-year. 10 year is the most popular though. And the thing about these loans is the 30-year compared to the 10-year, obviously you're gonna expect to make more on the 30-year bond because you're holding it for longer. So the government is giving you a loan for a longer, or you're giving the government a loan for a longer period of time. The government's going to pay you back a bigger interest rate. It's the same thing if you go to the bank. If you get a loan for a month, you're gonna have a lower interest rate than if you get a loan for 10 years because it's riskier. If you start a business, you go to an investor and you say, "Look, I'll double your money in 2 years." The investor is going to want to feel more comfortable doing that than someone that tells them, "I'll double your money in 30 years." Right? Because if you double your money in 2 years, you're gonna want to do it more often. You're gonna want a bigger interest, a smaller interest rate because you're gonna be able to do it more often. Compared to the 30 years, it's he's gonna ask for a lot more, a bigger interest rate to give you that loan. Does that make sense?
To be honest, no, not really.
Okay. If let's say you give me a loan for a business,
Okay.
and I told you that I could make your return, I could get your money back, I could pay you back in a month. Would you feel more comfortable than if I told you I could pay you back in 30 years?
Of course, yeah.
Yeah, so you would give me a lower interest rate on the loan you're giving me if I told you in a
Yeah,
month
yeah, yeah. Okay, yeah.
than 30 years.
Okay, that makes sense. Okay.
Okay. Yeah, for example, you might give me a 4% for a month, but 5% for 30 years.
Mm-hmm.
So that's the same thing with bonds. Typically, the 30-year bonds are going to be, let's say it's at 3%. 30-year bonds might be at 3.5%. I don't know why I keep selecting the wrong one. 3.5%. While or it maybe even higher, like at 5%, while the 10 years at 3%, and the 1 month might be at 2%, right? Because it's safer to go for less period of time. All right. The problem is that sometimes these bonds are going to be worth um this is the 10-year bond minus the 3-month bond. All right. And this becomes inverted. It goes to the negative when the 3-month bond interest rate, this is the y, the yield, when the yield for the 3-month is worth more than the 10-year yield, it becomes negative. Right. The subtraction is
This
negative.
is in
See, it's an
percentages?
anomaly. Hmm?
In percentages, yes. So the maximum
Yeah.
bond interest rate
Yeah.
was like around 4.5%, and now it's in percent.
No. No. This is if you subtract them
Okay. So the 10-year bond versus the
on a.
three-year bond.
Yeah. No, this is the subtraction. So if you take the 10-year yield and you subtract the 3-month yield, then you get the result.
Okay.
So here it's right now at least it's negative 1.21. I think the well we can check actually. We can go O3MY, not US O3MY. Right, this one is at 5.34% for 3-month bond. That's pretty high, to be honest. The yields rocketed in the past couple, since in 2022 when they raised the rates. But this is really high, and it's stayed at this level since the Federal Reserve isn't lowering the rates. And
Okay.
then you go to US 10-year. I think, yeah, this one. And you see it's at 4.2%. So if you take the 4.2%, you do minus 5.3%, you get a negative number. But
And
that
that's
doesn't make sense, right? What?
That's what it's showing on the chart you just showed me, the one the 10-year versus the
You were
3 month.
saying you were gonna say something? Wait, you cut out.
Oh, the connection is so bad.
Yeah. What'd you say?
I was saying the numbers you're looking at right now, the 4.4 minus the 3 month one, is the graph that shows the negative numbers for the negative
Yeah.
differences.
Yeah. Yeah. This is the graph that shows the difference between the two. So if you take this 10-year at 4.2% and you subtract it by the 3 month, which is at 5.3%, you get a negative about negative 1%, right? Which is what that's showing. So this doesn't make sense, right? Because like we said earlier, above here, right? When you have the longer term bond at 10 years, you'd expect to get a bigger return than if you had it at 3 months.
Yeah.
So the fact that it's inverted is showing you that okay, there's a problem here. What's happening is that people see risks in the short term. The rates are higher right now, so they're buying these longer term bonds more than they're buying the short term bonds because they think that the yields are going to stay higher. They think the yields will go lower, and so there's no point in buying the short term bonds because when it expires after 2 years and you're going to have to renew at those lower yields, they would rather keep those high yields, so they're buying these long term bonds. When you buy a bond, that pushes the yield down, so the yields and the price of bonds have an inverse relationship, right? If you go back up here and you have this 10-year bond at 3% and the interest rates go down to 1%, your bond is going to be worth a lot more money
Yeah.
than the
Okay.
current bonds are than what you that 1 trillion you gave, right? So
Mm.
so now the interest rates went up. So this 3% 10-year bond, if the interest rates went to 5%, it would be worth a lot less money. So
Uh,
people are buying the long end of the curve, basically, is the way you can look at it. They're buying the long end of the curve instead of the short term, which means that they're assuming more risk short term because the rates are going to get lowered.
so
So it's safe. Yeah, go ahead.
it's kind of like trading, to be honest. You buy a bond at a high interest rate and then you sell it at a lower interest rate and then you make money like that.
Yeah, I mean, some people trade bonds. Yeah, you could do that.
Okay, okay.
Yeah, so the every time this happens, basically people are assuming risks short term. Now, when it uninverts, you always have a crisis, right? So 2001 dot-com burst, people saw risks short term, so they started to buy the long end of the curve. Rates went up. Then rates had to crash down because unemployment went up. So when unemployment went up, they had a hard landing, as they call it. They raised the rates. People started to buy they started to buy short-term bonds again, or they started lowering the rates. So now people start to renew the short-term bonds, and they stopped buying long-term bonds. That's the important part. The long-term bonds, the 30-year bond, 10-year bonds, people stopped buying these things because now the rates were lower. So there's no point in renewing them, which meant that the lower-term bonds now assumed safer, compared to the long-term bonds. They were now safer, or they are assuming less risk for the short term. But that's once the crisis happens. So every time it uninverts, the crisis happens, and you can look at the date. The dot-com burst, it happened about January 2001. The housing market crashes. It popped October 2007. Actually, no, I think it was in the summer 2007. COVID, March 2020, just as it crossed above. And now here it's very uninverted. Last time it was this uninverted was during the stagflation, which this was a terrible year.
What's
If you
happening
look at
right
the
now?
stock market, hmm?
What's happening right now?
Well, I think that's something I don't try to do because it could be anything really, but I think it's going to be a liquidity crisis with the bonds. But we talked about all these other countries having debt in U.S. dollars, right?
Okay.
And the U.S. dollars, if right now they're providing liquidity to the world. Well, they were providing liquidity to the world. So if let's say China recently, they just sold their bonds, their U.S. Treasury bonds. What that means is that they're renewing because they have debt in U.S. dollars. They're renewing their debt in US dollars. That means that they're making their debt in US dollars bigger and bigger. So if China, let's say, holds 500 billion in bonds and they sell all those bonds, that's because they're trying to raise cash. If they're trying to get away from the US dollar, that would be they would hold on to those bonds so that they can pay back the United States. But if they're going to sell it, that means that they're raising cash to do, I don't know what they want to do with it, and then they're renewing the debt that they have to the United States because they're in debt to trade. So this dependency on the US dollar is gonna, anyone that's trying to not use the US dollar is gonna have a hard time. It's gonna be more expensive for them to get those United States dollars because their currency, no one's gonna want to deal with them because they don't have many US dollars. Again, it's like gold. Anyone that has the most US dollars, which is the United States, but any country after that is gonna be worth, their currency is gonna be more attractive than any other currency. So I think what we're gonna see is sort of a forex market crash, where all the foreign currencies are gonna have to, they're getting devalued already as the dollar's going higher, but they're gonna have to get so devalued to the point where there's gonna be some there's some balance sheet issues. So on the asset and liability, if the government has assets because they're in debt to other countries are in debt to the United States because of the trade deficits, then you would have the currencies, if they're worth less and less, that debt grows bigger and bigger on for the United States, and it's better and better for the United States, and that might cause balance sheet issues if the rates stay higher, because then, like we said, right, the rates go up to 5%, which they're at 5% right now. If they stay like this for a bit longer, more and more countries are going to more and more central banks that are holding bonds are going to start to go bankrupt, because, like we said, this current bond is worth less. At 3%, it's worth less than it was at 5%. And the interest rates 3 years ago were at 0.25%. So if a couple of years ago, all these and they were like this for 10 years. So within that last 10 years, if all these countries bought bonds at 0.25%, 0.5%, and now the interest rates are at 5%, nobody wants their bonds. And it could come to a point where they don't have the liquidity to sell them if the rates stay higher. And that could cause balance sheet issues, a liquidity crisis. And if depositors in these central banks, not that no one deposits in a central bank, but other than the government, if the government needs money in these other countries, they need to print money, they may not be able to do that. If banks fail because they're holding too many bonds and their depositors want the money, these banks might fail. If the central bank needs to bail out these banks, they might not be able to do that. So we're going to see a huge global banking crisis probably, and a forex market crash. And I know that's very hard to understand because I said a lot of things that you probably don't. You're going to have trouble wrapping your head around it. It might take you a couple times to listen to it, but yeah, like,
Yeah,
this is
I'm
the
gonna have
easiest
to
way I can
rewatch
put
this
it.
video. I'm gonna have to rewatch
Yeah,
a part of the stream. Yeah,
yeah,
but I have a basic idea about the balance sheets and what bonds are now and how they work and how they provide value. But yeah, I definitely have to
yeah,
watch it again.
yeah. Like, all you need to understand is, in 1924, or around that year, 1930s, there was a huge crisis, and it was the banks. They did not have yet the, like, system we have right now, where they're all insured by the Federal Reserve. It's like back then, people, they did their homework before putting money in a bank. Like, they actually, I don't know, they interviewed the bank. They checked the other depositors, the reviews. They didn't just pick a bank and say, "Oh, I'm gonna put my money on that in that bank." Right? Oh, there's a commercial on that bank. Oh, okay, I'm gonna put my money in that bank. They're offering me good rates. Like, it was way different. People had to do their due diligence. That's because they weren't insured. And what happened at one point is that so many people wanted to withdraw money from these banks that the banks didn't have enough cash in them to pay back. And actually, like my bank, they only have 5% of the total deposit money in the actual reserve of the bank in cash. So if everyone wanted to withdraw their money, if I went to the bank right now and I said, "Hey, I want to withdraw $30,000," they won't let me. I won't. They'll say, "We don't have the money for that. you need to set it up and you need to wait a month. You can't. If I want to close my bank account, it's gonna take a while for me to get my cash. You know, unless I want to transfer it to a different bank account because that money just isn't in the economy. It's not in cash. It's just numbers.
That's crazy, bro.
So yeah, so if something happens where people are worried and they want to withdraw their money, and these banks they don't have enough money, but also if they want to move their money to other banks and they get into trouble with their asset sheet because these bonds are worth a lot less, so if they go out and sell their bonds to raise cash, like China did recently, which they were able to sell the bonds, but if too many countries did that, and they would all take losses. Like China took a loss on the bonds they sold. Our bank in Japan recently, last month, took $10 billion loss on selling $63 billion in bonds. If that happens too often, you're gonna see a lot of banks are they're gonna lose too much money, and some of them might fail, like they did last year when the Federal Reserve stopped raising the rates in 2023. Some local U.S. banks started to fail. The interest rates were going too high and their current bonds were worth too little, and they were having balance sheet issues. When people wanted to withdraw their money, they were just they didn't have enough money to do it, to print and to get to the customer because they had to sell their bonds at a loss. So that's sort of what you can expect, potentially this summer, or maybe it might happen next year. It all depends if the United States wants to bail out these countries. But if at any time the United States says, we're not going to bail you out, we're not going to print money and send it to you, we're not going to help you out, well, it will cause the current forex market to be destroyed, and then that can give space to a better currency system, which there's ideas on what that could be, but it could be digital. So that's why there's a lot more risk right now. The fact that these yield curves are inverted, but why I really think that it's going to uninvert soon is if you look at the U.S. 30-year and subtract it with the U.S. 10-year. You'll let's get the 0% horizontal line. Do you see how this one is a lot clearer?
Yeah.
Like it inverts a lot less.
Hmm.
So you had the dot-com burst, you had the great financial crisis. It uninverted long before the financial crisis, and the crisis popped at around here. So the fact that it already uninverted tells you that any moment now, it's already going up. If it keeps going higher, that means that more people are starting to buy the 10-year instead of the 30-year. So this is a big, 30 years and 10 years. It's not going to be as inverted because it's less short term. It's more like long-ish term, but 10 years a little bit shorter term than 30 years. So they invert less, and the crisis pops a little bit after it uninverts. Then if you go to the US 10-year minus the US 2-year, which I was showing you the 3-month, but we'll look at the 2-year. This is the other one you want to look at, and this one, me, I want to get it on 0. Whatever. This one is starting to uninvert. And so if you look at the timing, you have April uninverts, and then the crisis pops in October around here.
So they can correlate, kind of.
Hmm?
They can correlate between this one and the other one.
Yeah, it's kind of like the Dow catching up to the Nasdaq, right? Like
Yeah, yeah.
the even the more shorter term you get, the more precise you're going to be on the timing that the crisis pops. So once this one inverts, which it looks like it's going to invert soon, then you can expect, okay, something is really going to happen, and then that's when you go to the US 10-year minus US 3-month field, and then that's when you look at this and you're like, okay, now when this inverts, it's really going to pop. But the thing is, it might not invert for another year. It might not invert for another 2 years. Like, it really it is very hard to predict.
Okay. Thank you for that. I think I'm gonna be ending my stream now, and I just have a bunch of alerts set. Um, as price
Yeah.
conditions, and I think I'm gonna be getting off the charts and probably gonna go work out or something. And
Yeah, same here.
I'll get back on when my alerts hit. But for now, I'm just gonna be sitting back.
All right, sounds good.
So end my stream
See you
now.
later.
See you. End my stream.